Picture this. A client walks into your office today and asks, "Hey, how are my standard deductions going to survive after April 2026?" Well, are you fully prepared with the answer? Welcome to this explainer. Today we're zooming in on a massive update tailored specifically for chartered accountants, students, tax pros, and business owners. We are going to demystify the brand new tax regimes under Chapter 13C of the Income Tax Act 2025. We're talking sections 199 through 205. This whole framework fundamentally modernizes our tax system, and honestly, mastering it is absolutely crucial for a smooth transition from the old 1961 Act.
So let's start with a really foundational scenario. How exactly does this monumental shift in timeline terminology, specifically ditching the old assessment year for the brand new tax year, actually affect your client's default tax regimes starting April 1st, 2026? Because, let's face it, this single question is going to govern literally every return you file moving forward.
Okay, we've got a lot of ground to cover today. We'll quickly run through the introduction to the new regimes, deep dive into sections 199 and 202, look at key conditions, walk through a practical taxation example, cover compliance and transition rules, and finally wrap up with common issues and a summary. Let's jump right in.
Section 1. Introduction to New Regimes, Setting the New Baseline.
For well over 6 decades, the Income Tax Act of 1961 relied on a pretty confusing dual concept, right? We had the previous year when the income was actually earned and the assessment year when it was taxed. Well, the 2025 Act throws that out the window and simplifies things entirely. That old previous year and assessment year split, it's now consolidated into one single tax year that aligns perfectly with the financial year. The income year and the assessment year now share the exact same reference. It's a real game changer for clarity.
And crucially, as you can see on this timeline, there's no missing year or weird overlap. Income earned during financial year 2025-26 is still governed by the 1961 Act and assessed as assessment year 2026-27. But the moment we hit income earned from April 1st, 2026 onwards, it seamlessly flows right into tax year 2026-27 under the 2025 Act. It's a clean, definitive cutover.
Moving on to Section 2, Sections 199 and 202, the statutory framework. The new Act sets up a very clear binary. On one side, we have Section 199. This targets domestic manufacturing companies, offering them a sweet 25% concessional tax rate provided they meet some very specific statutory conditions. On the flip side, we have Section 202. This establishes the new default tax regime for all your non-corporate taxpayers. We're talking individuals, HUFs, AOPs, BOIs, and artificial juridical persons.
So the absolutely crucial takeaway here is that Section 202 acts as the default. But don't worry, the legislature has kept taxpayer flexibility in mind. Just like the old regime framework, taxpayers still have the option to opt out if they crunch the numbers and find that the traditional deduction-heavy computation actually works out better for their specific financial situation.
Now, let's look at Section 3, Conditions and Terms, specifically the Section 205 restrictions.
If you want to benefit from those Section 202 rates, Section 205 steps in and dictates that you've got to let go of specific deductions. Most notably, this means waving goodbye to deductions under Section 123, which is the new Act's equivalent of our trusty old Section Xiii-C. Furthermore, and this will be detailed in the upcoming Income Tax Rules 2026, you cannot set off carried forward losses or depreciation from earlier tax years if they're tied to these now disallowed deductions. Essentially, your total income has to be computed strictly without these exemptions.
And listen up, because the law is incredibly unforgiving here. Any failure to adhere to these Section 205 conditions invalidates the regime option, not just for the current tax year, but for subsequent tax years as well. It's a massive domino effect. If you fail the conditions, the standard provisions of the Act kick in as if you had never exercised the option in the first place.
Let's make this concrete. Section 4, Practical Example, Transition Scenarios. Check out this table. Let's walk through a transition scenario. For financial year 2025-26, under the old 1961 Act, an individual could happily claim their standard Xiii-C deductions, like Provident Fund or life insurance, but fast forward to FY 2026-27 under the new Act. If that taxpayer just defaults to Section 202, boom, those standard savings deductions completely vanish under Section 205. So, as a tax professional, your job is to calculate whether actively opting out to claim those Section 123 deductions actually outweighs the lower tax rates of the default regime. It becomes a pure, personalized math problem for every single client.
All right, Section 5, Compliance and Rules, ensuring a smooth transition.
So how do we prepare? Employers and professionals need to overhaul their internal systems right now. First up, you have to literally eradicate the term assessment year from your payroll software. It is all tax year from here on out. Second, you'll need to reset your TDS computations to reference the new 2025 Act sections by April 1st. Just to give you an example, salary TDS shifts from the familiar old Section 192 directly to the new Section 392. And finally, you have to assess how your client's existing declarations are going to migrate using the transitional provisions found in Section 536.
Speaking of Section 536, it's really our saving grace here. It creates a helpful deeming fiction. Basically, if an option, an election, or a declaration was validly exercised under the old 1961 Act, and there's a corresponding provision in the new 2025 Act, it's deemed to carry over automatically. You know what that means? You don't necessarily have to refile every single piece of paperwork from scratch if the new Act has a mapped continuation. Huge time saver.
Let me give you a practical example of this. Think about the lock-in rules. The notorious 5-year lock-in period for business taxpayers who decide to opt out of the default regime, that carries over seamlessly into the new framework. So, if your client opted out and is sitting in year 3 of their lock-in under the old Act, that restriction simply continues ticking right along into the 2025 Act.
Section 6, Issues and Summary. Let's talk about common pitfalls.
Now, what are the biggest traps we're anticipating? Number 1, erroneously trying to claim Section 123 deductions while you're parked right inside the Section 202 default regime. Believe me, the automated tax portals are going to flag this instantly. Another major headache? Attempting to drag ineligible old losses into the new era. Remember, Section 536 only preserves validly determined losses. Also, if you use the obsolete assessment year terminology on the new digital forms, you're just asking for processing errors. And lastly, for your corporate clients under Section 199, keep in mind that an amalgamation only keeps that sweet 25% concessional rate valid if the newly amalgamated company continues to fulfill all the strict statutory conditions. Don't drop the ball there. Finally, Section 7, Summary. The key takeaways you need to remember.
Let's tie it all together. Ultimately, the shift to Chapter 13C modernizes our entire framework, primarily by introducing the beautifully simple tax year concept. It cements Section 202 as the strict but very clear default for individuals and non-corporates. It enforces compliance by disallowing traditional deductions under Section 205 if you stay in the default. And thankfully, it relies on the Section 536 transitional rules to save us all from administrative chaos. The transition happening on April 1, 2026 is designed to be seamless, with zero overlapping and absolutely no missing years.
So, as we transition into this bold new era of taxation, I'll leave you with this ultimate question. Are your compliance systems truly ready for April 2026, or will these new default regimes catch you and your clients by surprise? Thank you for watching. Please like, subscribe, and share. Disclaimer: this explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.